Hey, what's up guys? Welcome back to the channel. My name's Frank Mularcik, and in this video we're going to be looking at some more dividend stocks that I think are undervalued right now and could be a pretty good opportunity to pick up with the recent bit of market correction we've seen over the past few weeks and month or two. So I made a video similar to this just a week or two ago, and so I'm going to be going over some more stocks that I think are undervalued right now in this video. So the first one we're going to be looking at is Clorox CLX, and I actually don't own any of this. I could potentially be interested in adding it, but I'm really not looking to add a whole lot of new companies to the portfolio at this point in time. So it's just something I'm not looking to do right now. So that's why I would say I don't own it. So right now their dividend yield is right around 3%, 3.2%, and their dividend growth rate over the past 5 years right around 7.5%, which is pretty good. It's not fantastic, but it is something that I would be happy with, especially for a company that is a little bit more slow and steady like Clorox in a sort of defensive industry. It's not going to be growing super rapidly. So 7.5% is pretty good, I would say. And they've been growing the dividend about 44 years consecutively, which is pretty awesome to see. And if we go look at it from more of a valuation perspective, right now the earnings are the things that concern me with Clorox. So they've been growing the earnings pretty steadily, and then over the last few months they've just dropped off a ton. I tried to look into it briefly, and I saw some things about inflation really hurting them. So I think that'd be something worth doing more research on before I wanted to invest in the company. So right now their PE ratio is about 71, which, as we look compared to their overall sector, the average for the sector is around 22 in the consumer defensive sector, and then within their industry, consumer packaged goods, they're down here with 72, and their average is around 26. So again, from a PE ratio perspective, it looks like they're overvalued. But if I were more interested in the company, I would do more research, I think, on why they've struggled with earnings over the past few quarters. And maybe it's something simple that's not really a big deal, but that's just something I'd be cautious of, and one of the reasons that I would be a little bit hesitant to invest in this stock right now. But if we look at the chart, technically they look pretty attractive. Right now they're pretty much at a 3-year low. So the current stock price around $144. Just a few weeks ago they reached a low of around 138, and they haven't really recovered from that much. They're kind of consolidating here a little bit, so we might see a breakout one way or the other fairly soon. The RSI is right around 39 or 40 right now, so that's a good indicator, I guess. And they did have this big gap down here at the beginning of February, so there's an opportunity, I guess, to fill that gap. And so technically I would say they look pretty solid. The issue I would say there is that there's just not much history at this price level, so they've never really been in this price within the last 3 years. We have to go back 4 or 5 years to be able to see a time when we were in this price level. So they were back here about 4 years ago in 2018. They were around 135 in July of 2018, and been pretty much above that ever since. So I guess they have a decent amount of volume way back here, but that's 4 or 5 years ago, so I think that's less valuable to have that volume and support there. So right now I would be a little bit hesitant to invest in Clorox just because of the fundamental issues with the earnings, but that's also something I would definitely want to look into a little bit more before I really made a decision. So the next one we're going to look at is Home Depot here, and when I was kind of picking out these stocks, Home Depot definitely looked a little bit more attractive than it is right now. So right now the dividend yield is around 2.3%. I think it was a little bit closer to 2.5% when I was originally looking at it. And the dividend growth rate over the past 5 years though is 19%, which is stellar. They've been growing that dividend a ton. They recently announced a dividend increase probably a few weeks ago that was around 15%, so pretty close to that 5-year average. They have only been growing the dividend around 12 years, which is not a ton, but it's not like they had cut the dividend, I don't think. It's just I think they may have missed 1 year sometime back here. Yeah, like between 2007 and 2008 they didn't increase it for that whole year, so that's sort of why they lost that streak. But overall, I think that's not that big of a deal. So yeah, they increased it from $1.65 to $1.90 per share per quarter. Just a few weeks ago, they announced that, so that's pretty cool. If we look here from a earnings perspective, we can take a look at the earnings, and we can see that the earnings have been growing very steadily and fairly quickly as well, which leaves them with a PE ratio of around 21, 22 level. And the stock price has been growing very quickly as well, which is sort of why the PE ratio isn't any lower. The PE ratio sort of has been on an uptrend, over the past 10, 15 years, to be honest. And if we take a look here in the sector, I think they're here in this retail defensive sector. Or they actually might be in the other sector. I always get these confused. They might be in, yeah, I think they're in consumer cyclical, and then in retail cyclical industry. I always get that confused. I'm not sure why. But you can see here they're at a 21 PE ratio, which is, I believe, a little bit lower than the average for their sector, or sorry, their industry, which their industry is kind of skewed by these companies like Chewy, have a 2000 PE ratio or something like that. So that 163 doesn't really mean much, I don't think. But I think they're generally at a good valuation. Fundamentally, they're pretty close to where Lowe's is at, and Lowe's is a pretty similar company to them. If we look at a chart, we can see, it's really not a huge discount, to be honest, but it's definitely a little bit of a discount from where they've been at recently. So if we go back here, right now they're in these $324 level. So they were at this level, just back at a year ago, pretty much. So it's really not that big of a discount, but they do have a decent amount of volume here. And, there's, like I said, a lot of volume here. So a fair amount of support. And, the next level down that they would go would be probably around like 270, 280, 260 range. So if we saw another drop down to there, I think it would be a lot more attractive. But, at this point, it's not a super awesome buy, but it's definitely a nice little discount if you were looking to add more specifically to your Home Depot position. But for me, I think, again, like I was sort of saying with Clorox, it's not a fantastic deal, so it's not really something I'm looking to add to, just because it is a company that I don't own, and I would have to be adding it to the portfolio, which I'm not really looking to do that much. The last one we're going to look at here is JP Morgan. They're in the banking industry, financial services sector. So their dividend yield right now is around 3%, and their payout ratio around 25%, which is super awesome. Over the past 5 years, they've been growing the dividend about 15% on average, which is awesome to see. The only problem with JP Morgan is their dividend growth, consecutive years of dividend growth. So it's only been about 9 years, which is basically as a result of the stock market crash in 2008 that affected a lot of banks. So they had some trouble there, and then eventually reinstated or started growing the dividend again in around the 2012 range. So only 9 years of dividend growth there, which is really not ideal, I guess. But if we take a look at their earnings, they've been growing their earnings pretty quickly, over the past 5 or 10 years, which is good to see. And right now their PE ratio is around 9, which compared to a lot of other companies is fairly low. But you can see their PE ratio over the past 10 years has been in that 9 to 12 range. I would say right now 9 is a little bit on the lower end of that range. But it's definitely good to see that, their PE ratio has always kind of been in that range. If we look at this whole financial services sector as a whole, their average PE ratio is around 18, and if we look specifically in the banks, their average is around 11. So they're kind of in line with some of their peers like Bank of America, Wells Fargo, Citigroup, US Bank Corp. So PNC, they're kind of in line with a lot of those banks. So that's good to see, and they're a little bit lower than a lot of them. So lower than Bank of America and Wells Fargo and US Bank Corp and PNC, for example. So could be a little bit of a nice discount. I know some people were definitely looking at Citigroup. I think they might have had a little bit more of a drop over the past few weeks than JP Morgan, but I definitely don't really know as much about Citigroup, and I'm not as familiar with it. I do own JP Morgan, so that's something that for me, it just doesn't make as much sense to look at Citigroup, because I do know more about JP Morgan and I'm more familiar with them. So if we look at the chart right now, they're around this 134 level, and if we go back here, the RSI is right around 30, 33. So technically it's at a fairly decent level, fairly attractive, I would say. If we go back here, though, they really were, even just a year and a half ago, they were sitting in this 90 to 100 level for a long time after the March 2020 crash. So they crashed down all the way to around $75, and they were kind of choppy there. And then they were just kind of consolidating in this $90 to $100 range for a while until they kind of broke out and have been on a run the last year and a half or so. So I actually bought some of my first shares in this $90 to $100 level, probably around here fairly soon before they kind of started increasing over the past year or so. So I've been pretty happy with that, and I've definitely been adding to my position a little bit over the last week or two as they've gotten sort of towards this discount. You can see they kind of crashed down, not crashed, it's definitely not a crash. They dropped down here pretty rapidly to around 140, and then they kind of rebounded a little bit to around 155, 160, and they actually bounced off the moving average. I'm not exactly sure. I think that's the 50-day moving average. Yeah, that's the 50-day moving average there. So they kind of bounced off of that, and that acted as a little bit of resistance, and they just kind of came back down. So, for JP Morgan, it's a company that I do like a lot, and this is the only one of these three that I've actually been buying over the last few weeks, but I do think all three of them are at a pretty great discount, and they are very high quality companies that have been growing their dividends fairly quickly. They have been paying their dividends in most cases for a pretty good length of time. So let me know what you guys think of any of these companies, and if you have been looking at any other companies, mostly dividend companies that I would be interested in, down in the comments below. And just want to thank you all for sticking around to the end of the video, and I'll see you in the next one.